Today's guest is Nick Cooley. He is the co-founder of Rodeo Capital, and he is in charge of acquisitions and investor relations. Nick, welcome to the show. We're super excited to talk to you about what you guys got going on, and to help share some of your wisdom and knowledge and explain some of the projects you've got going on with our audience. So thanks for joining us today.
Yeah, I'm glad to be here, man. Hopefully, there's some wisdom to be shared, but I guess that we'll find out soon enough. So
We
here we
certainly
go.
will. We certainly will. But I heard you're the man to talk to, so glad to have you. So, before we jump into kind of what you're doing currently, a lot of times people when they're investing, they have like an origin story, right? And from what I gathered, you kind of cut your teeth in the brokerage side at Keller Williams. I know that before you decided to do that, you had been involved in some real estate, and that you were a little hesitant about maybe getting your license. What made you decide to kind of jump in, start at Keller, or just get licensed in the first place?
Yeah. So my real estate origin story, I won't go all the way back to when I was knee high to a grasshopper, but the origin story was I moved to Denver, met up with a former college football buddy, and he was actually working as a broker at the time, and he, it was New Year's Eve. And he was like, dude, you won't believe this, but there's people that I work with that they buy houses and other people pay them off. And that was how he explained real estate investing to me.
Sure.
And at the time, I was, mid 20s, thought I was going to be the VP of sales for a Fortune 200 company someday, these big aspirations. And my wife and I started buying single family rentals here in the Denver area, just the two of us. And so as we
Cool.
scaled that, and as we eventually ended up getting to about 18 doors, I learned how much the typical resi agent doesn't know uh, anything about, unlevered yield on cost, return on equity. They didn't know how to underwrite a rental property.
Hmm.
And so as that portfolio scaled, that was kind of what forced my hand into the brokerage side, is that our single family rental portfolio had gotten to the point where me not participating in the real estate market full time was costing us something.
Yeah, and that makes sense. And that's pretty awesome, and it's a big accomplishment, especially in a market like Denver. I mean, it's not like you've got low price points, so congrats
Yeah,
on being able to aggregate a portfolio like that. Um,
thanks.
Obviously, eventually though, you kind of decided to say, hey, this residential game's not for me, and you started pivoting towards under the banner of what's called commercial real estate, which is more on the multifamily side. What made you decide to make that leap? That's you're going from a couple $100,000 home, maybe $500,000 home, to multi-million-dollar assets. What was kind of the thought process behind that change?
Yeah, this is a really good question because it's twofold. Like, there's one that was very analytical, very data driven, and then there was one that was very personal, like the true inverse. And so it was 2021. We had a portfolio that was like 18 doors, and um, I remember looking at our return on equity, and like most people that are aggregating a single family portfolio, we kind of did it piece by piece until the scale really started catching on. And so I'm looking at our portfolio and kind of analyzing how efficiently it's working for us. And I'm like, we're millionaires, but we're not making any money on a monthly
Yeah,
basis.
yeah.
After you replace that one garage door and you account for all the things that go into proper underwriting. And I was like, this kind of sucks. Like, it's taking a lot of our time, and we were hoping to start a family around that time, and it's like, we're millionaires, but I can't buy diapers with it, or at least like not a
Yeah,
lot of them, right?
yeah.
And so that was the one thing. And then the second thing that we learned is scaling single family operationally, which I'm sure you know as well or better than anybody, is tough.
Yeah.
Every single countertop is probably different. The paint is different at many of them. Even if you had 18 brand new properties, you have 18 like distinct and separate roofs. And
Hmm.
so all of the operational inefficiencies that went into that was like, Financially, it's not serving us in the way that we had hoped for when we started down this journey. And on the day to day lifestyle of just how involved we are, my wife and I at the time, um, neither one of those was really scratching the itch as to why we were making all these sacrifices and hopefully delaying gratification for a later point in time. And so those two things combined is what made us actually liquidate the single family portfolio. And that acted as our seed round to get us into what we now focus on, which is commercial multi.
Cool. Yeah, awesome. And I think a lot of people, have that realization at some point, especially if they own more than a couple rental houses. They start to see, yeah, you're not getting a lot of economies of scale, and it's just really difficult to also liquidate down the line, and the valuations move around a lot, right? They're really
Mm-hmm.
subjective because somebody might pay, $50,000 more because they love the kitchen, right? And it's hard to anticipate that because it could cut the other way too. So.
Mm-hmm.
So I think that's a natural progression, and that makes a lot of sense. Before we talk more about kind of your operations and kind of what you're up to, what I'm curious about is, you know, the mission you have for your company currently. It's responsibly create better places for Americans to call home. Where does that come from? I mean, that's an excellent mission, and I'd just like to know more about that.
Oh, that's cool, dude. You're digging deep on me, man. I don't get asked these questions. This is fun. Um, uh, Nobody is going to get into this business. We raise capital from other investors, right? And so we have an obligation to create returns on behalf of our partners.
Hmm.
But that doesn't mean that we don't lose sight of the fact that at the end of the day, what we invest in and what we operate in on the day to day side, to somebody else, that's where they're hosting their daughter's fifth birthday party. And
100%.
like we take pride in doing that really well, or
Cool.
at least trying to.
Well, I think that's really powerful, and in our line of work, because we focus a lot on the management side, we we spend a lot of time talking about our core values because they really govern how we operate and really differentiate us from other companies. And it's really important for staff retention, right? To make sure that people have that same ethos and philosophy. Um, and so it's great to see that you guys are doing that. And you talk about, the importance of, grit, tenacity, work ethic. You embodied that as kind of the Western culture vibe, which, in some ways, is just, it's uniquely American, I think, obviously. And it's something that, built the West, right? And it's great to kind of, well, that, yeah, that and a few other things, exactly. um, so it's great to see to bring that kind of ethos. Is that kind of language around? Is that something that you guys use in your core values when you think about partnering with vendors or hiring people or
Yep,
taking on a project?
absolutely. So we kind of launched Rodeo in response to, there's a lot of funny business going on around the private placement real estate. It's an industry that the more that you get involved in it, the more that you realize uh, I wouldn't trust everybody that does what we do with my own capital, which is not to discredit anybody. There's also a lot of like very well intended and very upstanding people in the space as well.
Hmm.
But I grew up in a town of less than 1,000 people in Western Nebraska. And there's just something about like, no matter what I did, I knew before I got home that my grandma would have heard about how I handled myself.
Yeah.
And so there's something about like, let's bring that level of responsibility to how we interact with vendors, partners, tenants, where I think that there is something beautiful about like if you and I shake on it and I say this is what's going to happen, um, you can take that to the bank, and that's what we're trying to really emphasize and bring to this space.
Yeah. And have you seen that be helpful in telling your story to investors and people that are, trusting you with their capital?
Totally, yeah. At the end of the day, right? Like any kind of financial modeling or underwriting is going to be based on some level of assumptions. and that some level includes hundreds of assumptions on any kind of deal that you buy or operate,
Hmm.
I don't care how good you are, 5% of those assumptions are going to go differently than what you had planned. So at the end of the day, what really matters is who is it that you're entrusting with your capital? And on the flip side, if I accept Nick's money, are you somebody that I feel like we have a strong ability to communicate with and to say, hey, these are some of the challenges that we're facing. We saw 3 out of the 5 of them coming, and these are the plans that we had in place to try to mitigate that. But these other two, we're doing the best we can, and here's what we're currently doing. Um, let's see what happens. Like that's a reality of our business.
Yeah, no, 100%. And I think you hit the nail on the head with, being cautious about who's operating out there, you know, being on the management side, and that's where we kind of started. Um, or in your case, if you're working with investors, and we do that too, but the genesis of this was on the third party for my career, and we have something called a fiduciary obligation, and I cannot tell you how many people I've seen that are licensees what I would violate what I would consider their fiduciary obligation. Um, and even before I got into management, I flipped houses from 2005 to 2008, which was kind of an interesting time frame. And obviously in 2005, they just gave anybody money. But in 2008, things weren't going so well. And I saw some people, really get destroyed during that market. And one of the things I remember pretty clearly is that some of the hard money lenders that we used had people that they had been doing business with for 10, 20 years like start ghosting them, not calling them back, all this kind of stuff. And it just really blew my mind because to your point, I didn't grow up in a small town, but I definitely grew up with the principles of accountability and keeping your word and kind of death before dishonor kind of thing. And
Yep.
to see that there's people out there that are you know representing these assets and not taking that fiduciary obligation seriously is a big concern.
Sure.
So I'm glad that you guys are addressing that with essentially the company brand and essentially what you're looking for with investors and being able to tell that story. Um, what sort of markets are you buying in? I know you said you're from Nebraska, you live in Denver. Um, I'm not sure, I'm not familiar with the Denver market, but in Portland, the cost per unit's pretty high. So are you
Mm-hmm.
buying things, in larger metro areas like Denver, or are you branching out to areas where you've got a little bit, lower cost per unit? So maybe you could talk about what markets you're buying in, why you chose those markets.
Yeah. So we built our single family portfolio here in Denver just because it was familiar for us, right? One of the things that has held true during both kind of chapters of our real estate investing journey is that I'm a huge proponent of there are people that are making Portland work in the same way that there are people that are making Miami, San Jose, Flint, Michigan. Like there are
Mm-hmm.
people that are monetizing each of those markets. The big discrepancy is do you have a distinct and measurable competitive advantage in that market? And so for us, initially, when we weren't all that sophisticated as real estate investors, anybody that's listening to this from Denver knows that there's a difference from 45th in Tennyson and 42nd in Tennyson. Like that just is true. They're
Mm-hmm.
same street, and from Manhattan, maybe it would seem like the same submarket, but if on the ground, I can tell you it's not. And
Interesting.
so initially, that's where we started. As we started to scale, we actually moved away from Denver, and now we just buy in the Midwest. So Western Michigan, Nebraska, and Iowa
Mm.
are the major markets that we feel like we again have a distinct competitive advantage. But there's also some mathematical advantages to buying in markets where a Denver Class B product like we buy in the Midwest is probably going to be 275 to 325 a door, and that unit is going to generate 2,200 a month gross in rent.
Mm-hmm.
We just bought a building in Iowa for $67,000 a door, and that's going to generate 1,050 a month gross.
Yeah.
So the economics just make more sense, especially taking into account some of the policy risk regarding Colorado as a state as well.
Yeah. Yeah, and I think you make a good point. I mean, you can make any market work, but it kind of goes back to a function of what your goals are, right? If you're chasing cash flow versus appreciation, and also a function of how big your balance sheet is, right? If you've got a lot of money, you can play in markets, that are more expensive.
Totally.
Um, but yeah, and have you focused mainly on purchasing existing buildings, or have you been building anything? Like, what are you guys? How are you approaching your investment strategy?
Yeah. Our team has a background specifically in development. Myself and my co-founder have developed over $500 million worth of ground up, everything from hospitality to multifamily to. But with Rodeo, we are very, very, very fee light. We
Hmm.
only take a 1.5% acquisition fee, and that's it for all of our fees throughout. And so while we've been chomping at the bit to develop, we haven't found enough that's where the pricing makes sense to put money in the ground yet. But as soon as the economics of that turn around, we will happily do new development as well.
Got it. Got it. And in terms of your fee structure, what inspired that? Like, why did you guys? Because there's a debate about what fees you charge, how much you charge. Some people say, well, if you charge too much, then you're kind of fleecing the investors, and you're just fee rich, and you're not worried about the performance. And other people say,
Yeah.
well, you have to make a living, you have to pay your own bills, while these pro formas play themselves out. How did you kind of
Yep.
decide on your philosophy on that?
Yeah. And, I'm going to make a platform statement, but there's obviously nuance to the topic. Luckily, me and my team have always ate our own cooking. Like we have our own real estate portfolio in the background that's generating income for us to live on. And when you operate from a perspective that that is the truth, then I think the question of how much fees are the right amount to charge your limited partners, I think that conversation gets pretty easy pretty quickly. If I were to tell my limited partners, hey guys, guess what? You're going to put 90 to 95% of the capital at risk for this deal, and you're going to get 80% of the upside. And oh, hey, by the way, I'm going to make 6% a year in fees, fees, by putting your capital at risk. That just feels like an opportunity for there to be misalignment. So
Hmm.
anytime that there's an opportunity to analyze what are the behaviors that we want, and then what are we incentivizing, I think it's easier to err on the side of being extremely fee light because it just feels to us like that's the right thing to do when other people's money is at risk.
Yeah, makes sense. Now, I imagine, and maybe this isn't the case, but if your fee structure is set up that way, are you currently outsourcing your property management, or are you also doing that in house?
We do. We work with people that ride the property management bike every day. I would love to be an expert at everything, but I've ceded control of that part of our business to people that are the true experts. And so maybe that changes at a different scale of our business, but
Hmm.
for now, we work hand in hand with third party PM.
Got it. And so, since you've got a multi-state strategy, is this mean you've got different PMs in different markets, and you're kind of able to see how different ones operate, and see what you like and don't like?
Yeah. So we cover 3 states, have 2 different property management companies. The Nebraska Iowa thing kind of operates as one big market.
Mm.
Um, our property management company that handles those 2 markets is based out of Omaha. And then the Michigan part is based out of Grand Rapids. And so, in some ways, we do kind of get to have this is a really bad analogy, but it's almost like our parents are divorced. And so we get to see, like, oh, well, dad lets us have pizza on Fridays. Oh, well, mom lets us stay up late. And so we get to kind of have like best practices and hold each of the other ones to the standard that we've kind of gleaned from the other.
Hmm. And property management is its own kind of animal, and it's a difficult business to be in. Sometimes people who have not actually operated buildings directly don't necessarily know the ins and outs, and especially people who aren't like professional investors, right? Like they may have a building, but that's kind of like the extent of it.
Mm-hmm.
Um, they don't always understand the challenges that property management faces, and a lot of times they try to grind down on the managers in terms of fees,
Yep.
which is a resource issue for the management company, and then it prevents them from sometimes being able to really manage the property in the best way possible. What have you identified as things that, like, working with property management companies, that as an owner, as an investor, somebody who represents capital, um, that you're saying like, hey, I don't like this. I wish they did this differently. Um, do you have any tidbits along the way, tips that you've learned or thoughts on that?
Yeah, and just to make sure that I'm understanding the question correctly, you want like things that I would wish if I were building the perfect property management company, or things that operators can do better to help y'all?
Probably the first one, but the second one, if we can dive into that too, that'd be great. But yeah, no, the first one is really just kind of, what are you seeing? Where are you seeing the gaps that you're like, hey, I wish they were doing this because, I feel like we're speaking two different languages.
Yeah, that's a good call out. We actually work with. Uh, I have a really good relationship with both of our property management companies that we currently work with. That hasn't always been the case. Certainly I've worked with ones that I've enjoyed working with less than the ones that we currently are partnered with. I think the biggest thing, and it's something that we share and that we're obligated to, again, I keep using that word, as far as reporting and financial transparency, is just the quality of reporting. We do a lot of value add stuff there, so there's a lot of unit turns, and did we spend $9,000 or $10,000 on that last unit turn? Which unit was it? Did we use the
Hmm.
same? And so you and I know this industry better than 98% of people, right? The problem is I raise money from the other 98%. And so I
Yeah.
need to figure out, hey guys, sometimes it's a huge pain in the ass when one of the tenants' kids goes and sits out in their car and shoots BBs into like the dog park signs. Ask me how I know. Um, but like we're responsible for translating that day-to-day operation into digestible information on behalf of our partners. And
Hmm.
really, it's just that frequency and level of transparency on the reporting that I think you can never improve enough.
Yeah. Yeah, that makes sense. It's a great response. Great response.
Thanks,
Um,
man.
so, let's talk a little bit about investors here. You know, in any business, you've got customers, and to some degree, the investors are your customer, right?
Mhm.
And there's this old adage that people sometimes say, which is the customer is always right. And while that could be true in some businesses, perhaps it's not always true.
Mhm.
And who you choose to partner with matters a lot. And so, you could take money from really anybody that has it, right? That meets some of that criteria. But when you're looking for investors, what process are you going through to make sure that, like, hey, I want to be, in bed with this person. This person is somebody that um, is aligned with our values, and that is going to be a good fit for Rodeo Capital. How do you go about that process? What is that like?
That's a fun question too. I think the onus initially is less so on the investor, on the limited partner, and more so on us as the operator. And what I mean by that is to have a radical level of transparency in what we do and what we target, what we pass on, what we say yes to, what is the ideal that we're aiming for, both in return and product and all of the different levers that go into the bike that we ride on a daily basis, the business that we are participating in.
Hmm.
And then only once we can get that prospective investor to really understand what we're good at and simultaneously what we're not even interested in becoming good at, only then can we have a productive conversation on whether or not we're the right fit. There are
Hmm.
too many people that are screaming into Instagram Live, sell all your stocks and buy real estate. You can't trust the S&P 500. you should trust me. It's like, well, maybe, but you're also saying that every single prospective investor is a good fit for you. And that can't be true.
Hmm.
It can't be the right fit for you to go really deep on NVIDIA stock and simultaneously for you to go really deep on the 2-year treasury. Like it
Yeah.
just can't be true simultaneously. But after they've been informed and educated on what the ideal is and also what it's not for us, then I think it comes down to um, we specifically try to be the very boring, predictable, repeatable part of your portfolio. We're not IRR driven. We actually do this really crazy thing in private placement real estate where after we buy the assets, we actually move to pay them off, which is whoa,
Yeah.
never heard that one before. Um, because we view real estate first and foremost as a principal preservation play with incredible tax benefits,
Mm.
both of which you're risking losing if you're going to play the 5-year flipping the apartment game and chase IRR. And there are some people that do that very, very well, but we don't aspire to be great at that. And so we ask for people that are okay getting that 6 pref for the first 3 to 5 years. But in 30 years, that 6 pref is going to turn into a 600 pref as inflation does its thing and as we pay off the asset. And so if you prioritize predictability and certainty over the long term, then we might be a good fit for you as a limited partner.
Yeah. And I think people who have, good, reasonable time horizons for their investments, I mean, that's really the way that you should be investing. Real estate is kind of like the story of the tortoise and the hare, right? And people who are just trying to chase IRR, that might work out here and there, and you might hit some amazing home runs. But over the long run, you're going to be at serious risk. And right now, there's some people out there just getting their face ripped off in the capital
Yeah.
markets because they're stuck in bridge loans that they're not going to be able to extend. They may not even be able to get out of their construction loan, and it just to lose someone's capital is such a substantial like problem and candidly in some ways failure if you're reckless, right? I mean,
Mm-hmm.
no investment is immune from loss, but there's some things you can do that obviously ratchet up the risk. And I think, it depends on whose money and what they're signing up for. But I see a lot of stuff where people don't, they really just don't know the operational side, so they can't underwrite properties very well, and
Mm-hmm.
and that puts people at risk. And it's interesting. We talked earlier about residential brokers not really knowing how to underwrite, uh, rental property, single family homes. But I found that a lot of multifamily brokers don't actually know how to underwrite apartment buildings very well either. And that's also a concern because they're handling off this life changing asset for better or worse to somebody. And
Mm-hmm.
we've come across clients that weren't even aware of some pretty major regulations in our market that is going to have a huge impact in the performance of that building. So yeah, you've got to really just commit to learning, so that you know enough to ask the right questions.
Yeah.
Um, and so, I mean, I love your guys' business plan. That sounds like the right way to go. It's not, sexy on the front end, but over the long haul, you're going to have some cash cows that are just going to kick off, lots of money over time. And, you can always go find more depreciation and things like that. But no, I think that's a super solid strategy. What do you think the hardest part about raising capital has been? A lot of times people say, well, you find a good deal, the money will just flow to it. And while that's probably true in some respects, it's not an easy button, right? So, like, what have you
Yeah.
found to be the most challenging thing about raising capital?
It's a good question. I think the biggest thing is I think a lot of operators try to do it too quickly right now. It's been made so famous on Instagram, and real estate is a get rich quick scheme, right? Like everybody I see that's doing it on Instagram has a Lambo, so
Yeah.
real estate has to like. I've been doing real estate for 3 months. Where's my Lambo?
Yeah.
And I think that there's a certain part of the raising money thing where you as the operator have to understand it's not about the prospective return or, hey, here's what can happen if everything goes well. I think it's that lack of experience on the operator's part where they fail to comprehend just how valuable it is to have a distinct and firm understanding of here's the 100 different things that we're going to do to help, we can't guarantee, to help ensure that your original principle is not at risk. And
Hmm.
only once that is well established and I feel comfortable as the limited partner, okay, once we've got that base covered, now tell me about what's going to happen if it all goes well. But the professional allocators and the professional investors, and to be frank, if you're just starting to raise money, the people you actually want to work with, they're going to place the fear of loss at a 10x level higher importance than the 1,000% return that's possible if everything goes well.
Yeah. Well, it's like, Warren Buffett says, right? Rule number one, don't lose money, right?
Rule number
Rule
two.
number two.
Yeah, go
Oh,
ahead. I don't want
yeah.
to steal your thunder.
No, it's all good. Exactly,
I,
right? Read
I
rule
think of
one.
the I think of the Charlie Munger quote where he says, "Show me," and I'm going to paraphrase this, but show me where and how I will die, and I will spend the rest of my life avoiding that place. Like if you
Fair
can
enough.
do
Yeah.
that in real estate, dude, you're going to be a multi-millionaire. If we're compounding up and to the right without resetting the clock,
Hmm.
it cannot come as a surprise that you end up becoming a billionaire with a long enough time horizon.
Yeah. Well, I mean, there's a reason that real estate's created the most wealth for anybody in the history of, the human economies in the planet. So, I mean, it's just like, why reinvent the wheel when you've got something right in front of you? So, no,
Welcome
that makes
to the Nick and Nick podcast, where we both say how much we love real estate. Let's go.
that's a great title for a podcast. I like
Hey,
that.
man, we might be onto something.
It could be. Um, yeah, so cool. Well, I think that's great that you're going through that process with investors and, kind of lining up everything to tell the right story and to vet people out and make sure, you're on the same mission. Um, Another thing that people ask about, when they're, looking to invest in a company is, skin in the game. And so it's like, do you guys put money, like your own money in some of your deals, or how do you guys handle your participation in that?
We do. Historically, we've done a co-invest that ranges from 5 to 10% of most of what we do.
All right. Yeah, solid.
Yeah.
So you're
Well,
putting your money where your mouth is.
hey, we like to say, man, we eat our own cooking too. So it's I can't tell you how good this is for your family, and then me not want to participate in the model myself. So
Yeah.
it's not like, oh well, Nick is making me, I have to throw some of my own money in. It's like, no, we're a believer. Like I truly want some exposure to what it is that we're building,
Hmm.
and if that weren't the case, I think it's fair for somebody to look at it and be like, well, why should I participate in this if the product that you're selling isn't good enough for you and your family? You know.
Yeah, 100%. Indeed. All right, sir. Well, we're going to take a quick commercial break. So we will be right back. Okay, we're back. All right, Nick, round two here. We've got some more questions. We kind of ended some of that last discussion around, whether or not an investment's good for you and your family. Um, and it sounds like you're obviously actively investing in your own deals, which is great. But what about kind of the broader involvement? Do you have other family members that are involved in your real estate business, or is this something that you've kind of, been the lone wolf in charge of this sort of thing, or do you collaborate?
Yeah, we again, there's like the two chapters of our ongoing real estate story, right? Chapter one was Nick and Hannah, my wife, um, and my default bias is towards growth and revenue, and I'm a believer in some ways that revenue kind of cures all ails. Um, Hannah, a professionally trained emergency, nurse practitioner, will find that 0.1% thing that will kill us, and she will work to eliminate that via control and proper organization. That was also partially what made me want to get out of the single family space.
Mm.
And so I joke that Hannah was fired from our real estate company solely because uh, husband and wife was more important to me than business partner, Nick and Hannah.
Sure, sure.
And so we do have, in the iteration that exists today, we do have family members that co-invest alongside of us.
Hmm.
But luckily, I only go to Hannah on opinions regarding the business when I want them, and she's
Hmm.
not forced to participate on the day to day.
That makes sense. Yeah, I've seen some couples, probably like two or three ever, that manage to be in business together and really just like, benefit from that synergy and crush it.
Mm-hmm.
But that's always been a challenge, I think, for a lot of other people because it's like there's no unplug moment. It's like we're talking about work during the day and at night and on the weekends, and you've got to have some really complementary skill sets, and it just seems extremely complicated. And my girlfriend right now, we've been together for 4 years, and I'm trying to get her to like participate in some ways, mainly because like she has a skill set that I actually don't possess in the same way, and that is that she absolutely loves spreadsheets. So she's a
Great.
financial analyst, and so she can do things with Excel that I've never seen anybody do in my entire life. And I'm like excited that she like I love seeing the product of it. I don't want to build it, right? Like I can
Yeah.
build spreadsheets to do what needs to be done because I had to when I was studying real estate finance in college and went through that whole process. So I can do it, but I'd much rather just read something that somebody built or at least like provide the inputs. And so I'm hoping in some fashion that I'll be able to lean on that expertise. She's got a full time job that's not real estate, so we'll see where that lands. But it's definitely one of those things where I'm like, okay, you might be able to like be the canary in the coal mine on some stuff here, and because she's just like loves like reconciling bank statements down to the penny, and I'm just like, this is
God
not
bless
where
her.
I know, like this is not where I want to be at all. So
I'm so glad you exist, but you can miss me with that. That is awesome.
yeah. Um, so it sounds like in 2024 you were pretty active, pretty busy, which was awesome. I saw a couple posts you had and things like that. What lessons, if you had to just pick like two, that you take away from 2024 that you thought may be worth sharing with the audience?
uh, Work to, again, I'm probably unqualified to advise many of your listeners, but the one thing that I think we do well is that we are really clear on what success is for us. And
Mm,
no matter what a podcast says, or any one podcast, I should say, we've accumulated multiple decades between our team members' experience in this space. And for us, long term, I hate to say it, passive income on behalf of our
mhm,
partners is king. And we're huge on unlevered yield on cost. We've figured that out over 10 years of banging our toes against and shins and elbows on everything else. Like we have the battle scars on how we got here.
mhm,
Um, but we think basis is king. And so for you, if you're an operator or considering investing alongside another one, I think that there's power in distilling what success looks like for you to one or two very meaningful criterion.
mhm.
And so that way, when you do have that clarity, it allows you to move with speed on the thing that actually moves the needle for you.
Yeah. No, I think that's a great takeaway. Speed is, that is a competitive advantage. And I think that goes back to knowing the market, right? You have confidence if you know what you're buying and you know where it is and you can move quickly. Um,
Well, and just one last thing on that too, really quickly, and
mhm.
cut me out on the editing room floor if I'm
No, go
overstepping.
for it. No, you're not. Go for it.
Um, but I think, and now that I say that, it's funny. This actually is going to get edited out. Um, Damn it, I lost it. Never mind.
All
Sorry.
right. We'll come back to it. I'm sure it'll pop in there. So,
Yeah.
Um, the other thing too is just getting your perspective on current market kind of sentiment or fears. There's a lot of you know issues right now around interest rates, around a potential recession. What are you kind of anticipating or gearing up for as we move forward?
This is perfect. This is exactly what I was just going to say.
Nice.
So I think one of the things that, because we're in the forest, we tend to overlook that real estate is a business that has been around since the Romans. Like it's kind of always worked, especially on the multifamily side. There was a point in time where maybe like the mall was like the trophy asset of anybody's
Hmm.
commercial real estate portfolio. We're pretty bullish on the fact that even if people are wearing VR headsets into the office, you're going to be doing that from a living room somewhere. And so, as long as there's a utility case, it's honestly why we prioritize unlevered yield on cost and basis to the extent that we do.
Hmm.
At the end of the day, if you bought a valuable asset that is capable of producing a repeatable, consistent cash flow, at some point, interest rates and all the other micro stuff, certainly they matter. And I'm not advocating that anybody just throw that to the wind. Um, but for all of those Instagram syndicators that were buying three caps in Denver in 2022,
Yeah.
if you were willing to pay that for this thing, and because of tariffs or whatever else is going on, if I can buy that same thing at a 20 to 25% discount, yeah, that's awesome. Why would I not participate in that?
Hmm.
So,
Yeah. Yeah, I mean, it's, time heals all wounds in real estate. So the key is being able to hold on to it long enough that you can, make it through. And that's one of the things that we tell people in our market because of the regulations is like, if you're going to come in here and buy something, plan on holding it at least 5 years. You
mhm.
know, 10 years would be ideal, but 5 years is at least going to allow you to absorb some of the potential additional risk and operational cost. But obviously, the longer the better. And it's one of those things like amortizing debt is like hard work, right? There's so much
Mhm.
interest that you're paying for. And so it's kind of, I think that's why, your model is long term the right decision because you're putting in all that work to retire that interest and then people liquidate the asset and start that game over. And I understand, you kind of balance things. So you might have some deals every now and then. You just say, hey, this one is the offer is too generous. Like we have to we have to liquidate this thing. That does
Yep.
happen, but it's the slow and steady kind of component. So what do you guys have planned? Just transitioning for 2025. Is it to kind of stabilize what you have? Are you looking to acquire more? Like what is on your agenda for this year?
Yeah. We're closing out our a fundraise right now, and we aim to be buyers throughout all phases of the economic cycles.
Hmm.
Whether that underwriting looks like a 20% IRR, air quotes for those of you listening in, or an 11, like we claim to be buyers through all phases. And so that means, we adjust our offer accordingly, but we are net buyers. And I personally am really excited about this year and next year as net buyers, just because I think with our very long term horizon, investment horizon, I think that there's going to be incredible buying opportunities, and our calendars reflect that thesis.
Yeah. Yeah, no, that I think it's a good opportunity as well, and especially for people who are thinking long term. I think the other thing too that is maybe an unintended benefit of being committed to buying through the cycles is you will become an institution in the market, and that will give you leverage when you go to buy because people will say, look at Rodeo Capital, they make offers, they close on those deals. There's certainty around their offer, whereas you might have somebody come in that isn't an institution. And that was one thing in the Portland market when we were in our heyday before things kind of went off the rails. We had a lot of people coming in from like, East Coast, New York, Wall Street trying to buy stuff. And they struggled. And what they didn't anticipate is they did not have the broker relationships here. People didn't know them. They didn't know if they
Mhm.
were kind of fly by night or not. And that boxed them out of some potential opportunities. So, that's a competitive edge that you're also building through that kind of commitment to buy cycle in, cycle out. I love that.
Yeah. Good
Um,
call. It shows you, your experience in the space that you know recognize that, in my opinion. The other valuable thing that we've even begun to notice, you know, at our relative, uh, you know, young careers in the space is being as geographically constrained as we are. There's a beautiful thing that happens when you're kind of your own comps. Dude,
yeah.
we can have such a high conviction about, hey, we bought this building and it's, you know, at 60% of market rents. I know that tenant avatar, and I know with a pretty high level of certainty exactly where the market is going to tolerate this with, you know, new countertops, LVP, blah 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 blah.
Hmm.
And so there's a level of de-risking it from our perspective just by being institutions in the market as well.
Yeah, no, that's a great point. It's a great point. Well, I've got one more formal question, and then we're going to pivot to three questions to get to know Nick a little bit better. But the last formal question I have is, what advice would you give to someone who wants to get started in investing in real estate? Would you say, go buy a house, invest with somebody like you, take down their own multifamily? Like, what would advice would you give to somebody who's like wanting to get started?
The multi-million dollar question. I, I hate to answer a question with a question, but I think it depends on their time horizon and honestly what their income is like, right?
Hmm.
Um, I'm very public about the fact that when Hannah and I started our real estate journey, we started with a negative net worth, like
Hmm.
zero, less than zero. But for us, we didn't really have much to lose anyway. So it made sense for us to start with like the 3.5% down FHA house hack, live in it for a
Yep.
while, and then go buy the next one thing. However, if the roles were reversed, and I'm talking to me today, you know, you have a decent income, certainly much more financially stable, especially if you're a high earning W-2 earner. It's like we've learned the real estate game through blood, sweat, and tears over 10 plus years.
Hmm.
You've probably gotten to that same point in medicine. It would be harder for you to spend that 10-year stupid tax to get to where we're at now. It's probably better for them to just invest that other extra energy into their day job, which they have a track record of success in already,
Yeah.
and to just invest alongside us that comes with a high level of transparency. And then you can accelerate that 10-year stupid tax. And maybe you learn it in 2 years. And then if you choose at that point in time that you want to go out and do your own thing, by all means. But I just really think it depends on that person and what their goals are. I do want to make it clear, and sorry, at risk of rambling, but if you are somebody that does want to go out and do your own deals, you certainly can. That still works. I do think it's important to note that in the single family space, like we started, I think it's going to be much more difficult to do the quit your job as a bank teller and live off of passive income. It's not your fault, but the change in interest rates and the change in the market, I think is going to make it much more difficult to replicate that in the next 10 years as it was over the last 10.
Yeah. No, I think that's, an excellent response here. We try to tell people, time horizon is obviously a great question. But we ask people like, what is your goal, right? Like, what are you trying
Yep.
to achieve, right? Is this because, at the end of the day, to your point, there's an opportunity cost for their time. And, it's like, why are you, it's if you're a high income earner, it's like, are you changing your oil in your car? It's like you
Yeah.
probably shouldn't be unless you really love cars. Like if you love cars and you like that whole thing, and that's kind of like your unplug third rail stuff that you do, then go for it. But that may not be the best time. And real estate has a brutal learning curve, especially in
Mhm.
property management. And most people, especially if you're starting out, if you are in a position to even qualify for the financing, you're signing a personal guarantee. So not
Mhm.
only do you lose the asset if it doesn't go well, but you're putting yourself in a lot of jeopardy. And to your point, there's still opportunity for people who are hungry, who want to make it happen. You can do it, but it's not like a dip your toe in the water thing. It's like, hey, you're all in, and be prepared for the roller coaster ride. So,
I think if you're well capitalized and you want to buy, up to 10, like if you're going to buy more than 10, like just go to commercial.
mhm.
But there's also, if you can do one at a time for the next 10 years and then you get to 10 that way, I'm all for it. But I would view the single family thing as, hey, I'm very well capitalized to hold this. Like, what's a median detached single family home in Portland? 500K?
It's probably a little higher than that, but I mean, it's
Okay.
probably, maybe 700 realistically.
Wow.
Yeah,
Okay. So
I know it's
that's like
crazy.
Denver prices.
Yeah.
Denver's is like 715. So I know the Denver market a bit, obviously more so than Portland.
Hmm.
Uh, your typical single family home in Denver is going to cost you 715 grand. And it's probably, if you're honest with yourself about the underwriting, it's going to be cash flow negative right now.
Hmm.
Um,
Yeah.
a great deal if you're taking into account vacancy reserves, maintenance, capex, all that. Maybe you make $150 a month, which awesome. It's going to cost you $150,000 down, and it's going to get you like a good but not a great bottle of wine once per month on your date night if nothing breaks.
Yeah.
And so if you're well capitalized enough that you can do four of those, I'm pretty confident that it will appreciate in value over the next 30 years.
Hmm.
But then it
Yeah.
comes down to Nick's point about like, is being cash flow negative for the next 30 years with a pretty high level of confidence that it'll be worth more later. Is that investing or am I speculating at that point in time? And
Hmm.
I would argue, as the guy that gets paid to raise money, so bias acknowledged, uh, I would uh, I would advocate that it's better to be participating in a cash flow positive commercial asset, and maybe you're only getting 75% of the proceeds from that. Uh, but still, I think net you'll be in a better position long term.
All right. Well, excellent. We are going to transition now to a few questions about you. Um, that's right. The exciting stuff here. So, one of the questions I have is if you could have dinner with one person, dead or alive, who would it be?
Dude, this is ironically enough, I was just talking about this yesterday with a friend of mine, and
Ah,
I think it would have to be Winston Churchill,
oh, all right.
the most American British dude of all time, with like peak swagger. You're the you're walking around town as your city's getting bombed with a cigar.
Yeah.
Hell yeah, I want to have dinner and a steak with that guy. That'd be dope.
Yeah, and his humor was on point. The thing that I'll say, if you haven't done it, and if there's a podcast out there called Founders Podcast,
Yep.
and it's incredible. And he's got a couple episodes about Winston Churchill and like early stages of life, and it's wild. It's wild to hear about that person's whole
I'm
life.
gonna seek those out. I haven't heard those. That's a
And
great call.
they're incredible. All right, next question: whiskey or wine?
Ooh. Uh, I pride myself on my ability to appreciate all of life's little treasures, including whiskey or wine. But I'm actually in the process of studying for my Psalm 1 cellar manager. So I'm going to go wine.
I love that. We are going to have to connect about that because I last summer for fun I took the introductory sommelier course from the Masters of Sommets last summer. It was like a 3-day course.
Yeah.
And I took that for fun because I am into wine and whiskey. And we actually, in the Willamette Valley, we have amazing Pinots and Chardonnays. And we've got Walla Walla not too far and stuff like that. So we'll have to, and I actually collect bourbon as well. So that's kind of the reason for this question.
No
But
wonder
I
we're
did not.
friends. See, this is all coming full circle.
That's right. That's awesome, man. Congratulations. That's exciting.
Yeah. Thanks.
Um, and then the last question I have here is, being an entrepreneur means you accept the consequences of risk, right? Not everyone has the appetite for that. Do you think that's something you were inherently born with, like it's in your DNA, or was that something you learned to appreciate and
Hmm.
accept?
Ooh. Dude, we could have done a whole show on this. I think I was certainly born with a certain level of it, but I think it's been refined and enhanced over time. And one of the things that I think that's interesting about the perception of risk is the reality is like we're even the guy that has a super steady W-2 as an accountant, there
Mm-hmm.
is risk that that firm is going to go under or that they decide to relocate or offshore it. So I think entrepreneurs are maybe more aware of the risk and decide to try to take more control to counteract it.
Mm-hmm.
But I think most entrepreneurs would say, dude, we all have risk. It's just what are you going to do about it? And we and other entrepreneurs that are listening in, this is our coping mechanism: is to try to saddle it up and ride it
Yeah.
ourselves.
Yeah, I think that's a great way to describe it. I've not heard it described that way before, but that's pretty spot on with, yeah, that makes, I like that. Cool. Well, Nick, it's been a pleasure talking to you. Really, really enjoyed learning more about your operation at Rodeo Capital, what you guys are doing, and just getting to know you more as a person. So thank you for joining us on this podcast today.
Thanks for having me, man. This is fun.
Cool. Okay, so I'm going to go ahead and put